All right, let's dive right in. Today, we're going to break down two really important ways you can protect your investments inside a popular retirement product. We're talking about the buffer versus the floor.
So let's start with a question I'm sure a lot of you have thought about. How in the world do you get a piece of the stock market's growth without getting totally wiped out when it drops? It's a huge dilemma, right? Especially the closer you get to needing that money.
And that's exactly where something called a registered index-linked annuity, or a RILA for short, comes into the picture. You can think of it as a kind of middle ground. It's built to give you that potential for growth linked to the market, but, and this is the key part, with features designed to limit your losses. And those features usually come in two main flavors: buffers and floors.
First up, let's tackle the buffer. Honestly, the best way to picture this is like a shock absorber for your money.
So here's how it works. With a buffer, the insurance company basically says, hey, if the market drops, we'll take the first hit. They absorb a specific initial percentage of the loss. If the market falls more than that buffer amount, then you're on the hook for the rest.
Let's walk through a quick example to make it super clear. Imagine you've got a 10% buffer. And, the market has a bad year and drops 25%. Well, the insurance company steps in and absorbs that first 10% of the drop. That means your account value is only reduced by the leftover 15%, not the full 25%. See how that works?
Now, of course, there's a trade-off. In exchange for you taking on the risk of those really big losses, the ones that go beyond the buffer, the insurance company typically gives you a higher cap on your potential earnings in a good year. So it's fantastic for protecting against those smaller, more common downturns, but it's not going to save you completely in a major market crash.
Okay, let's switch gears and look at the other strategy, the floor. If the buffer is a shock absorber, you should think of the floor as your absolute, rock-solid safety net.
A floor is exactly what it sounds like. It sets a hard limit on how much you can possibly lose. It gives you a clear, predictable, worst-case scenario for your money in any given term. It doesn't matter if the market falls off a cliff, your loss will not go past that percentage.
And this example really shows you its power. Let's say your contract has a 10% floor and the market just gets hammered. It drops by 40%. Well, it doesn't matter. Your loss is stopped. It's floored at just 10%. That's it.
So the huge advantage here is that predictability. You know your exact downside. It's great for preserving your capital. So what's the trade-off this time? Well, because the insurance company is taking on all that massive risk, your potential for gains is usually a bit lower. That means you'll probably have a lower cap on your earnings compared to a buffer strategy.
Okay, this is where it gets really interesting. Let's put these two strategies head-to-head and look at the actual numbers. This is where you can really see the difference. Check out this table. We're looking at both a 10% buffer and a 10% floor. Now look at that first line. In a small 10% downturn, the buffer is actually the hero. It protects you completely. You lose nothing. But with the floor, you take that full 10% loss. But now look down at the bottom line. When the market drops a scary 40%, the buffer still leaves you with a painful 30% loss, while the floor holds strong and limits your loss to just 10%. Big difference.
And if you're a visual person, this bar chart just screams the story. And that severe downturn, look at the difference. It's massive. You can clearly see how much more protection the floor gives your hard-earned money when things get really bad in the market.
So after seeing all of that, the big question is pretty obvious, right? Which one of these makes sense for you and your financial goals?
Generally speaking, a buffer could be a really good fit if you've got a longer time horizon until you need the money. You know, if you're in your 40s or maybe your 50s, you have more time to recover from a potential loss, and you might be more comfortable accepting a bit more risk to get that higher growth potential.
On the other hand, a floor, that often makes a lot more sense if you're getting close to retirement or maybe you're already there. At that stage of life, protecting what you have becomes priority number one. A floor gives you that priceless certainty about your worst-case scenario, and that's just critical when you're planning to live off your nest egg.
So you see, at the end of the day, there's really no single right answer here. Choosing between a buffer and a floor really just comes down to your personal situation, your timeline, how you feel about risk, and what you need your money to do for you. It's all about finding your perfect balance.
Figuring out that balance can be a little tricky, and that's honestly where some expert guidance can make a huge difference. At the Annuity Expert, this is what we do. We specialize in comparing all these different options to find the strategy that truly fits you and your goals. And by the way, our services are always completely free.
So if you want to find out whether a buffer or a floor is the right kind of protection for your retirement plan, please feel free to reach out. We'd be happy to offer a free consultation with no obligation at all. Thanks for watching.